What's going on, guys? This is Tony with Success is Imminent Trading and Coaching. I want to talk to you guys about economic and political factors that will help you decide your bias, either long or shorts, with whatever instrument you're trading. Now, I've gone over US indices before, and I'll probably go over it again right now. But this goes for anything because, it might not be the US government that you need to study up on for your instrument. Like for Japanese yen, you need to know the Japanese economy. For Australia dollar, you need to know Australia. You need to know how to research your instrument's government or whatever is affecting it. If it does have a government, you need to know how to do that. And then when it comes to like things that don't really have a government, like metals, gold, silver, oil is also kind of doesn't really have a government, but it does have political factors that will drive the price up or down. So let's go over how to research all these things and figure out your bias for your instrument. And of course, we're going to start with the US indices first. So US indices, I've gone over this, there's a bunch of things, but basically inflation data, interest rates, bond yields, employment, US companies. There's a few things you'll need to understand about the economy when it comes to US indices. You go to your resource tab, right? And I've opened up, I have this economic and political researching PDF for you. And you'll come in here and it talks about a few things about inflation, different types of inflation. But down here, I tell you about PPI, CPI, and PCE. These are the three main measures of inflation that the government uses. Then I also tell you about unemployment. It's for how well the economy is doing, right? Companies doing good have no reason to cut employees and are growing means indices will go up. Companies going down have reasons to cut employees to save money or are spending way too much money, so they need to cut employees, or means US indices going down. And so that's why if we see unemployment going up, we can likely use that as a good sign of whether or not US indices will go down. Because what is the US indices, right? It's just a basket of US companies and it's tracking the average price. So we need to know whether the economy has any hindrance. And so inflation and unemployment are some of those things we can do. So unemployment is obvious. If it's up, then it's bad, right? So just to get it straight, if unemployment is higher, it's sort of like a sign held up that says companies are doing bad for one reason or the other. Because if companies are doing bad, that means they have less money to hire employees. Or if companies don't have enough work or can't work, for example, COVID shutting down the economy and needing less employees, then also companies are going to do bad. So that is why if unemployment is up, US indices go down because US indices is just tracking US companies, right? Unemployment will kind of tell us that companies are doing bad, but why are they doing bad? So why they are doing bad can be seen with multiple different metrics. And so one of these metrics is inflation. Deflation, if I ask ChatGPT to explain it for me, says deflation isn't just prices going down. It's one of the most dangerous macroeconomic conditions because it affects spending, debt, wages, and overall economic cycles. So deflation is bad because consumers don't want to buy things. Wages fall or freeze. Companies earn less, wage cuts and layoffs. So if companies are selling things for cheaper, then of course they're making less money. And so what they might do is cut employees. And what did we say about that before? Less people with money, slower economy, prices go down, kind of starts to spiral. You see what I'm saying? Because it kind of loops around, right? People don't have money, people stop paying, companies have to lower the prices, deflation starts to keep spiraling downwards. So it can get real scary. Japan has a very interesting case. Okay, so a good example of deflation is Japan. So Japan has a very interesting history with its economy, where back in the 1980s, I believe, or 1960s, they had a lot of people buying real estate and having a lot of loans from the banks because the banks were giving out loans super easily, and they were using it to buy real estate, and real estate prices kept rising up. So it kind of created this staircase of like people get loans to buy real estate prices rise up, people get loans to buy that real estate, and it keeps rising up and up and up. So it keeps on rising up in that way, and that's what we call a bubble. And it doesn't just happen with real estate, it happens with everything. It happens with gold, it happens with US indices, it happens with anything with value, as if the demand is strong enough to the point where you end up having people taking out loans or very risky leveraged money to put into this and to get it, you create a bubble. Because as soon as this bubble that I'm talking about, as soon as whatever's in that bubble has some kind of fracture, that bubble it explodes, okay? That bubble pops. What ends up happening is the people that have leveraged, taken out loans and put it into these things have to pay it back somehow, and they can't pay it back with the things that they bought it with, right? Because they more than likely bought these things in expectancy to pay back their loans with it. So these things can create bubbles, which when popped will create a cascade downwards. In a similar way that it created a way up, it goes to the way down. And this way that it goes down is basically people get margin called, people can't pay off their loans, and people start selling and prices get lower and lower because nobody's buying it anymore. Because I taught you guys this, right? Supply goes up and the prices come down because nobody's willing to buy. Just like if you have a car at $5,000, nobody's willing to buy that $5,000 car, you're going to bring it down to $4,500 or somewhere down, right? You're going to keep going down until you find a buyer. And so a similar thing happens the down ways of when the bubble pops, it goes down because nobody's willing to buy, and it keeps going down and down and down. And so Japan had this interesting case where basically, and all sorts of things were at all-time highs, prices were just keep on continuing to rise, and it popped because the Bank of Japan rose their interest rates. So what is an interest rate? An interest rate is simply the price of borrowing money. And the Federal Reserve, which is its own entity, but it's backed by the US government, the Federal Reserve controls the interest rate. They control whether it goes up and down. So they control how easy it is to borrow money. So it says here, if interest rates are high, borrowing is expensive, economy slows. Because people can't borrow money to use. People don't have money, access to money. It's the interest rate on your credit cards. It's the interest rate on your car, on your house. And so this is one of the tools that the Federal Reserve uses to control the speed of inflation and economy. So if the Federal Reserve isn't under the control of the government, why do they have this ability, right? Because the US government gave the Fed this legal ability. They gave them this way in order to basically, just like how the rest of our government works, where we give power away to different branches, the Federal Reserve is almost like its own branch. Not really, but it kind of is, right? Fed's job is to keep stable prices and keep employment high. And to do that, the Feds must control inflation, recession risk, and credit availability. Interest rates are the Fed's main tool to hit those targets. So does the government give the Federal Reserve permission to print money? Yes, but in a very specific way. The Fed does not physically print cash. The Treasury prints physical money. So the Treasury and the Federal Reserve are different. The Treasury is actually under the government and is controlled by Congress. So the US government and its people actually are in the Treasury and control the Treasury. But the Federal Reserve is different. The Federal Reserve is controlled by its own people. However, they have the ability, and that's their main goal. Now, the Fed creates digital money inside the banking system. So, for example, the Feds buy $1 billion of bonds. It credits bank accounts with the $1 billion of newly created reserves. And this is allowed because the Congress passed the Federal Reserve Act in 1913. The law gives the Federal Reserve authority to create base money. The Feds use this power to stabilize the financial system. So, yes, the Fed has legal permission from Congress to create US dollars electronically. So, the Feds buy $1 billion in bonds. It credits bank accounts with $1 billion of newly created reserves. Why is the Fed independent if it prints the government's money? Because if the government controlled the money supply directly, politicians would print money to win elections. Again, as what I was saying before, the reason why we split the power is to avoid corruption, right? Well, it's the same kind of idea with the Federal Reserve and why they give them the legal power to do this, and how they work together. Does that stop corruption? Obviously not. Okay, it's not. That's just not how the real world works. Unfortunately, there's going to be ways that they influence it, but that's the idea behind it, right? Why does the Fed have so much power? Because modern economies depend on credit, interest rates, and whatnot. You need a referee in that money system. The Federal Reserve is in a way a referee. Of course, when it comes to money, there's going to be a lot of corruption. Obviously, there's a lot of crazy stuff in this world, but that's the simple explanation that I'm going to give to you guys, okay? Now, reserves are just the money that banks keep in their accounts at the Federal Reserve. Think of the Federal Reserve as the bank for all banks, all right? You keep money in your bank account, and banks keep money in their reserve account at the Federal Reserve. That's why they call the Federal Reserve. These reserves are not public money. They are not spendable by you or the government. They exist only inside the banking system. So why do reserves exist? It's to help banks settle payments with each other. For example, $5,000 from Bank of America to Chase. Behind the scenes, Bank of America reduces its reserves at Fed. Chase increases its reserves. This is how the banking system balances money transfers. To meet regulatory requirements, banks must hold a certain amount of reserves for safety, called reserve requirements or liquidity requirements. This prevents banks from lending out every dollar they have. So how do reserves relate to money printing? And here's the key, right? When the Fed prints money, it actually creates bank reserves. So for example, the Feds buy $1 billion bonds from the bank. The Feds pay by typing $1 million to JP Morgan. This $1 billion is new money, but it stays inside the banking system, the Federal Reserve. Banks can't use reserves to pay employees or buy things, so Feds create reserves, not deposits or cash directly, but reserves allow banks to create deposits when they lend money. Why the Fed controls the economy with reserves? When the Fed increases reserves dramatically, quantitative easing, banks become more liquid, interest rates fall, lending increases, stock market rises. So when borrowing becomes easier, what did we say? Money is more accessible, economy starts to be more active, and in return, inflation goes up, but mostly the companies do well, right? When Fed removes the reserves, quantitative tightening, banks tighten credit, interest rates rise, economy slows, markets fall, these banks are less likely or less willing to lend out money. And what do we say about when it's harder to borrow money? It causes people to not spend as much money, and and then companies do worse. Reserves are necessary because banks need reserves to move money between each other. The reserves protect the system from bank runs, and reserves are basically liquidity safety buffer, right? Without reserves, banks could lend out 100% of deposits. If customers wanted cash, the banks would instantly fail. So reserves are, required emergency liquidity so banks don't collapse daily. And the reserves allow the Fed to control interest rates. This is how they say it costs this much to borrow, interest rate, right? They say that's how they do it, is because they control the reserves. No reserves equal no interest rate control. And of course, it ensures every dollar in the banking system is accounted for. Imagine a world without reserves. Banks wouldn't have any unified ledger. Every bank would make its own internal money. The financial system would be chaos. So physical money is tiny compared to the real economy. You know, all the cash in circulation in the US is about 2 to 3 trillion, but the total money in the economy equates to over 20 trillion. Physical cash is only like 10% of the money. Imagine trying to run modern society with cash only, paying your rent with wheelbarrows of bills, transferring millions between companies would require armored trucks, and international trade would be nearly impossible, so digital money lets banks settle payments instantly, electronically, and anywhere in the world. The Fed credits reserves to a bank account, banks lend money to customers deposit this loan in their checking accounts, and then there's digital money multiplies in the system. Physical cash is just a tiny fraction of this digital money. You know, what would happen if all the people ended up taking their money out, right? If it's really like that, if people just took out all their money and had it in cash? Well, a bank run would be a problem because banks operate on fractional reserve banking, meaning they only keep a small fraction of deposits as physical cash or reserves. The rest is loaned out to others, invested, or otherwise used. Reserve requirements: banks must keep a minimum amount of reserves at the Feds. If a bank is short on reserves, the Fed can lend money instantly, and they can print money through this reserve, right? Remember? And then deposit insurance is the FDIC that guarantees deposits up to 250K. This discourages panic withdrawals because people know their money is safe. So if something scary happens, people aren't just going to run and pull their money out anymore because it's guaranteed. So yes, if every single depositor demanded cash at the same time, even a strong bank would fail without the Fed stepping in. This is why reserves, central bank, and insurance exist. So this is why it all exists. Okay, this is why it's there, because this little intricate system that we have with banking and money works off of the reserves, because they control the interest rates with these reserves, because that's how the banks lend money. So they say it takes, 4% interest rate. We take 4% when you borrow money. Your savings, 4%. You earn 4% on your savings. Et cetera, et cetera. Everything 4%. Then it rises or it lowers, and it just entices people in different ways. So when the Bank of Japan had this idea to raise rates, but their economy was in a bubble because everything was pricier and people had all these loans, people were pulling out loans to buy expensive things like real estate, and that was how they were able to afford it. But once interest rates had raised, they weren't going to make money when they bought these houses to earn money back, because the interest rate kind of offsets the profits that they would make. So it either stopped them completely from buying real estate, or it just made it not worth it to buy real estate with these loans because the interest rate was so high. And so when they rose this interest rate in this big bubble of the economy where people are making that staircase up of buying houses, pulling out loans to buy houses, prices raise, and repeating that cycle, it stopped the loans, it stopped the house buying, and so all of the extra money that was going into housing and causing the prices to rise just stopped. That's obviously going to be an issue because that's the only way that people were affording this in the first place. Then it starts to make that staircase down that I was talking about before, because nothing is going to drive it up anymore. It's at the very top. There's no other way to get it up, right? And so it keeps on, the bubble bursts and it keeps on going lower. That's how they ended up going into deflation, where people could not afford to pay off their loans. People couldn't buy the real estate anymore, so real estate prices kept going down. People weren't willing to buy, and it just kept going in this cycle. Taking out loans at that point was an extremely risky thing. Buying real estate was an extremely risky thing. And then you lose your trust in banks, because if you do it today, what's going to stop them from doing exactly what screwed you over in the first place tomorrow? Not only that, but if real estate prices are now coming down a ton, why do you not just wait for tomorrow for it to keep coming down lower? Is not being sold and they keep on discounting the price down and down and down, then why is it that you wouldn't wait for it to keep going down until you're very enticed, right? When they realized this problem, it was already too late. And when they decided to cut the interest rate down to zero, like literally you can borrow money and you don't have to pay anything back besides the money that you borrowed, right? People were still not enticed to borrow money anymore, either because they were still paying off those loans beforehand and they're already in a ton of debt, or they just had this mentality that the economy is screwed. And that deflation depression can happen, and the same thing can happen the opposite way. In a well, not the same thing, but in a different way. Bad things can happen when inflation is super high, because deflation, prices get lower and lower and lower, but inflation, prices get higher and higher and higher. A little bit of inflation is good because it encourages spending. We're still going to buy things because we know it's going to rise tomorrow. Maybe not crazy, but we still have a reason to buy. It supports wages and profits. Companies don't have a real good reason to lay off anymore. Keeps the economic cycle healthy. So the Fed's target is 2%. We're not at 2%, by the way, but that's their target. So high inflation, 5 to 10%, that's bad. It erodes purchasing power, brings wage price to spirals. People need more money to afford things, and so they buy things. Companies raise their prices. People need more money to buy things again, and it keeps on spiraling the same way it spirals backwards in deflation. And it hurts savers, because inflation going higher than your interest or your savings or your bond yields, of course, is going to hurt. Runaway inflation is a crisis. The definition of stagflation is high inflation, low growth, high unemployment, because it spirals, One of the hardest environments for policymakers and traders. In the late 1980s, Japan had massive asset bubbles, real estate prices up 200 to 300%, stock market nearly reaching $39,000. Then the bubble burst in 1990. Real estate crashed, stock market dropped 80%, banking systems froze, and that was the birth of deflation. So why deflation kept going and became permanent? After the crash, households and companies stopped borrowing. Banks stopped lending. everyone was repairing balance sheets. Wage deflation, wage stagnated for decades. Lower wages, lower spending, lower prices, lower wages again. Companies can't afford it because they're not getting money from what they're selling, so they'll lower the wages again, and it'll just keep going in that cycle. Zero interest rate trap. So by the mid-1990s, rates hit zero. But cutting rates from 1% to 0% doesn't matter if nobody wants to borrow anyways. Monetary policy became nearly useless. Japan's population aged dramatically. There were more retires, spending less, fewer young workers earning less, population shrinking. When population shrinks, demand shrinks. That's deflationary. This alone is a huge structural anchor. At some point, people expect low prices every year. Consumers think, why buy a car now? It'll be cheaper next year. And what Japan tried, Japan used every aggressive tool before US even considered them. The results were 30 years of low or zero inflation. Stock market took 32 years to return to its 1989 high. $39,000 was about here in 2024. So we just recently finally came back to where it was in 1990. And Japan avoided a depression but lived in a permanent soft recession. And the same goes for inflation, right? Inflation, opposite way, destroys purchasing power because things get expensive, but your salary hasn't changed. You still make the same amount of money, and you feel poor. And so you ask for higher wages, and high inflation acts like a tax. It silently taxes you. Inflation discourages savings because why if you have high inflation and your savings earn less than inflation, then you're basically doing nothing. So now that you know how inflation affects economies and deflation affects economies, that's why we aim for that 2% sweet spot where it allows people to want to buy, but it's not getting things out of control. So in these bubbles that can happen, euphoria at its peak, people believe prices will never fail or fall, people quit their jobs, borrowers take insane risks, experts make wild predictions, and then the system becomes fragile. At the top of the bubble, prices are extremely high. People are highly leveraged, meaning they put a bunch of crazy stuff into this, and then all of a sudden, any small thing can cause a chain reaction where price will just end up liquidating people, taking people out, causing them to sell, and figure something else out. So this is where all bubbles eventually burst, because at that point, people are putting in money that's not even theirs. They're putting in money that is not even. This is extra money. You know what I mean? So when that extra money stops and nothing else is pushing this up, that's obviously going to be part of the top. What happens after the trigger, the real burst? Price falls slightly, people get nervous, leverage investors face margin calls, forced selling, lenders panic, buyers disappear, price collapses, and that's how every bubble ends. In one simple sentence, bubbles form when optimism is high and easy money pushes price up there, and especially when there is leverage. When people are really leveraging a bunch of money that they don't have and are planning to pay it back after they get the returns from whatever it is they're putting your money to, which we use these metrics like what it says here, PPI, CPI, and PCE. And for example, PPI is the measure of the price of goods sold by manufacturers. So are companies pricing their goods higher or lower? And then we measure it by a percentage, and it's either going up or down. Are companies on average hiring their prices or lowering their prices? We said before, with inflation, if it gets high, it can spiral. If it gets low, it can spiral down. So we try to keep it at that 2%. And then we also need to know the interest rates. They will stimulate the economy by making borrowing easier or making borrowing harder. So if they lower the interest rates, it makes borrowing cheaper. People have more access to money. People are more enticed to use that money to spend on their company, on goods and services and all types of stuff that will boost companies in the US, which is why cutting the rates will raise the US indices, S&P 500, NASDAQ up. But once that inflation comes in, inflation is dangerous, as we've seen before, and that can be really bad. So what happens is, once inflation starts to rise and get heated up a little bit, and we see companies start to raise their prices and people are spending less, and what ends up happening is the governments will raise the rates. And what raising the interest rates does is it makes borrowing harder. And then it makes borrowing, people are less willing to borrow money. Once that extra money, that lending money is taken away from people, the economy starts to slow down. So prices start to go down, right? Because people aren't going to spend more when it's pricier. Companies are forced to lower their prices, and it's a balancing act. It's a balancing act between the borrowing money, the spending of money, and company prices, or any prices. That's why we use interest rate data and inflation data. And then we also use unemployment. While we watch the prices of things going up and down to measure inflation, and we're watching the Fed's interest rates to see how hard it is to borrow money, we also see who has money. So unemployment claims if it rises, unless people have money because they don't have a job, the economy is going to slow down, or companies are going to have to lower their prices. It's an indicator, and it shows us where something's wrong with the companies. We can see that if unemployment goes up or down, what's that going to do? It's going to cause companies to go down. So US indices are going to go down. Unemployment goes down, more people have jobs, more people have money, people are going to spend more money. So unemployment being down is a very good thing. Money is in the economy. So if we expect rate cuts in December, of course, we're going to expect a spike because we have no reason for us to end up failing. Companies have a reason to keep going up. The trade war has pretty much eased off. Not really big news on tariffs recently. And so, we're looking good for this December, this last quarter of the year. So what are bonds? Bonds are basically the government saying, well, bonds can be with anybody. It can be corporate bonds. So you can go to a company and they can give you a bond, which is basically a loan. Well, the government does this. The government has US bonds. Bonds are basically lending to the government, and the government will pay you back plus extra for letting them borrow your money. That happens through the treasury. So the Treasury issues these government bonds, and they issue them through the banks. Well, the Federal Reserve print money through these digital reserves, remember? And they will use that reserve to buy government bonds from these banks. So what will happen is the Federal Reserve will go and buy like a 10-year bond, $1 billion worth of it, and they can decide whether or not to, whenever those 10 years are up, to continue to buy bonds, or they'll just let it go. How did they buy those bonds in the first place? With the money, digital money that they printed, the reserves. So this is what we call quantitative easing and quantitative tightening. So when they're quantitative tightening, they're no longer putting their digital reserves that they printed into the economy through these bonds or through other things. There's other things too, but mostly bonds, right? Whenever it comes time that the bonds mature, not really the banks, but the government has to pay back whoever bought these bonds. And if they pay back the Federal Reserve, well, the Federal Reserve will get this money back that they printed in the first place. You see where I'm going with this? And so it's valueless to them, and they can decide whether or not to use this to continue to put the money into the economy, or they can just let it disappear. And you know, you might be wondering, like, how does it disappear? Well, it gets taken away from the U.S. Treasury. The Treasury pays the Federal Reserve for these bonds plus whatever, you know, extra, and the Federal Reserve just says, you know, I'm not going to reinvest it. It doesn't matter anymore. And what that does is it takes away money from the banking system. So there's less money. You see where I'm going with that? But if they want to boost the economy, what they'll do is they'll keep buying these bonds, and that'll keep printing the money and putting it into the economy. So that's what we mean when we say printing money, right? That's quantitative easing through things like bonds. And other things too about it. Now I'm just focusing on bonds right now. When the Treasury issues bonds, it sells them to the public or the Fed to borrow money. The government doesn't own its own debt. People, banks, institutions, and the Feds own it. Even though the Fed is part of the government ecosystem, it is a separate institution with its own balance sheet. When the Fed buys bonds, Treasury gets cash, Feds get bond, Treasury must repay that debt when the bond matures. So yes, the government pays back the Feds just like it would if you were to buy a bond. So Treasury sends money from the Treasury general account to the Federal Reserve. The Feds then delete the money. They said, I won't reinvest this. I'm removing this liquidity from the system. So the money disappears. And why can the Federal Reserve delete money is because the Federal Reserve created that money in the first place. So what happens when the quantitative tightening ends? Now the money flow is, you know, the treasuries repay the Feds, and the Feds immediately buy new bonds. So nothing gets deleted and the liquidity stays the same. The Fed's role is to, you know, either use this to put more money into the economy or take it out. So back to our notes, you can see how it all ties together now. I'll talk about inflation, unemployment, how companies are doing, why the Federal Reserve affects everything, how the interest rates can affect how people spend money or take away money or stop spending money, how companies can respond to things like economic crises like COVID or tariffs, especially when they need to cut costs or things are too expensive, how bubbles are formed whenever prices are so high, especially when people are leveraging money by borrowing money in order to do that, and how interest rates, if risen after the fact, can cause a cascade downwards. You can use that for any government. So if you're over here trading British pound, is there a reason for the British pound to go up? In the next video, I'm going to go over how we can understand Forex pairs, how we can understand which currency of the pair is leading, and understanding how to compare the policies and understand a directional bias with the Forex. So in this case, I've already written down US dollar is weak, more strength in foreign currency, because they take money out of the dollar and put it into their own currencies or other currencies. And Euro's interest rates were cut, plus they had lower inflation rates, meaning that we can see, or end up seeing, a spike in Euro's US dollar futures. After I go through that, I'm going to go over metals and oils, and that should make it complete. So thank you guys for watching. My name is Tony with Success is Imminent Trading and Coaching. If you enjoyed this video, please leave me a review. If you need one-on-ones, let me know. If you need your call, let me know that too as well. Group chat, keep sending your charts and getting it reviewed. And thank you guys for watching.